Let's take it to the editor's cut now because there's a very important piece around what is arguably been the most talked about stock the last few days, weeks, I could argue, Alex, for the last few months.
Certainly. The first narrative, Neeraj, was when is HDFC Bank going to play catch-up? And that kind of fell through the floor, one would say, right? All right, so, but let's talk about it. HDFC Bank since mid-January down about 13% despite the gain in trade yesterday. It was a bit of a relief for those people that are betting on the bank for the long term. And we're going to talk about whether or not certain aspects that have come through source-based conversations that Vishwanath Nair has had, whether that's going to alleviate some of that selling pressure, and in fact, whether or not the stock can gain at all from this point. We'll also talk about what the management's role in all of this has been, and Sajeet will bring some perspective into that. But Vishy, let's talk about the source-based information that you've picked up first.
Right, Alex. So what we understand through speaking to some sources who are very close to this entire decision-making process, the idea is that the bank is going to look at selling some of the assets which are linked to high-cost borrowings. Now, you have to remember that for HDFC Bank, the high-cost borrowings were the biggest pain point during the third quarter. From 8% of total liabilities, because of the merger, that portion, the borrowings have risen to about 21%. This was primarily because HDFC Limited had a lot of borrowings on its balance sheet, which transferred to HDFC Bank. Now, what the management intends to do is sell some of these high-cost assets, and then once you sell those assets, then obviously you can start releasing those high-cost borrowings, and that brings down the cost. It also brings down the loan-deposit ratio, which was another pain point for HDFC Bank. 110% on the loan-deposit ratio. So once you start reducing the loan portion of that equation, the ratio starts making a little more sense. So currently, the difference between the advances and deposits is about 2.5 lakh crore. Right. During the merger, the bank got a lot of builder loans from HDFC Limited. One would estimate that about 80-85% of HDFC Limited's loan book was individual home loans. Sure. The remaining 15 to 20% is coming from the developer loans, yeah, which is the problem area. So once you start selling down those loans, then you can ease out that borrowing portion. The bank also intends to keep churning out PSL compliant loans, priority sector lending, because a bank is required to have 40% of its total credit in priority sector. So that they will continue to generate as well as hold. For the other loans, they will generate and they will look to sell down because it makes more sense to give it to the market and retain maybe only the management fee portion of that deal rather than keeping the asset on your book and, of course, failing on the LDR portion.
What is the implication, if at all, of selling these loans in the securitization market on the profitability of the bank?
It doesn't really change much because what you lose out on the margin front of the deal, you make on the management fee. So that sort of covers it balances things out.
But and just to follow up before I go to Sajeet on his view on the management, there is a considerable gap, as you pointed out, 2.5 lakh crore. And earlier we were talking about how deposit growth has not come through. Yeah. 40,000 odd crore was the increase in the third quarter.
During the third quarter, yes.
Which is kind of lower than what they've achieved in the past, fair enough. But even with the sell down and release of some of those deposits, high-cost deposits, will they be able to bridge that gap?
So what the bank intends to focus on is growing the deposit base. Now that is part of the core decision-making process. Now, what has happened during the October-December quarter, unfortunately, the bank went through a leadership reshuffle of sort, right? Under Shashidhar Jagdishan, there were multiple business leaders, and as part of his management philosophy, he has reshuffled that portfolio. So new people came in who took some time to just adjust the business. Now that's the reasoning that is coming through from my sources. But what is also part of the discussion is also that the pie for deposits has come down. The incremental deposit growth in the system is slower. Right. And HDFC Bank continues to hold about 18 to 20% of that incremental deposit share, which is healthy. But since the outstanding number has come down, that 80-20% is also coming down. So 1.5 lakh crore, which they reported in the previous quarters, may not happen right away. Sure. But this 40,000 crore is probably an outlier, and it is likely to steadily go up.
Okay. So a combination of those two factors. Yeah. Sajeet, I kind of know what you're going to talk about, and it's not a pretty picture, right? Because one has to look at the role of the management in managing expectations and also in including the investor base in what their vision going forward is. There are certain issues that they knew would crop up. I don't think that a gap in deposits and lending is something that a bank does not get aware of in the process of merging. What is the point that you're making?
When there's a promoter-owned company and you have a professional management, the management is reporting to the promoter, and he's responsible for whatever it is, and the promoter is taking the fall for it. In a bank which does not have an unidentified promoter, it is the management or the MD and CEO whose responsibility is to answer to the shareholders, simple, directly. You have a mechanism in the market where you give at the end of the quarter an advance notification to the market and to the shareholders about how the quarter went by, what are the ifs and buts in the quarter. If there is any surprises, you bring in that communication. The communication was not there. Now, if some of the sources are saying that, oh, some of the sell side analysts may have put a sell, there were institutions like hedge funds who sell. The thing is that share price was punished because of information asymmetry, which is there. Now, our markets thrive on information asymmetry, and they made gains on that.
And the institutions that sold were not obliged to hold.
They are there to make profit, not to manage support the management. They are here. Their KRAs are to make profit on the investments.
Right.
So whether it's in a hedge fund or it's any other fund which is shorting or are doing an arbitrage on that information asymmetry and getting a gain of 13-14%, it's their right to do it, and there's nothing wrong in it. In this market to do it. Market punishes and rewards based on information asymmetry. A management which is very good in communicating, there's a reward that comes in because in form of a premium coming into the stock. If you are poor in communicating, you get punished in that. We've seen in some of the IT companies where the management have been upfront in doing it. Despite negative news, despite anything, we've seen stocks going up. There is a valuation there. Of course, the PE ratios may have fallen a little bit because of that. But there isn't this kind of surprise that is coming in. Market does not like surprises. And if you create an information asymmetry or a gap between what you want, what you promised and what you delivered, then there is a problem for that bank or the company.
It's a harsh lesson, I would think.
Can I just add one point on this? So we have to remember that for a lot of the private banking ecosystem, the last 5 years, you've seen big management changes.
Yes.
Now, typically, associated with management changes is something known as kitchen sinking.
Yes.
Right? When the new management comes in, you see a big dip in the asset quality, you see a big dip in profitability, and then things start to take out. In the last round of management changes, that has not really happened. So there is a little bit of like what exactly is happening with this management change and what is the surprise element. And if information asymmetry, as Sajeet puts it, is the problem, then people just latch on to that, and that becomes the
just look at it, right? It took them 7 days to come out with some kind of information, and that too on a source-based thing to all platforms there. 7 days when you have seen 32,000 crores of delivery turnover happening on that stock.
Yes.
And there is a churn still going on because you have 50% or more than 50% of your investors who are foreign investors, and they're not happy in any way.
And you can call it therefore a failure in communication.
It is a failure. Means if you were in the US, you would have been questioned by the board or the shareholders, saying that what are you doing?
So. Okay, so we've established certain aspects. The question is whether this incremental information is going to be enough to stem the tide that we've seen so far. Yesterday, you saw a bit of a breather in the price of HDFC Bank. We'll see soon enough what the reaction to the latest update is.